people, and in my firm, there's a lot of retail investors who look at a report that I write and think that it is, it's some sort of holy, scripture, right? That this is the way that things will definitely be, and I don't want people to lose money on my opinions.
You do, all of you, I think, most of the analysts that I've seen, they have more buy recommendations than sell recommendations. Despite that fact, we have an industry where all the stocks are trading significantly below their NAV and below where you guys say that they should be. So I cannot blame you for the industry not being better and stronger as all us think it should be, owning the companies and comparing prices to NAV. What is the reason for this lag that we see? It's not you publish generally a little bit more bullish reports than where the prices are. What are the reasons? Is it the cyclicality? Is it the small size of the companies? We had this discussion in the previous panel as well, but it's interesting to listen to the analyst's view on that. Donald?
Sure. I think cyclicality and company size are both factors, but I also think maybe trying to get the message of people to understand the shipping sector to a broader audience is also something that's hard when they look at kind of how the stocks have traded and trying to understand some of the complexities of the industry. I think sometimes they have a hard time wrapping their head around it. And then when you look at things like the company size, some people say, this is an interesting idea, but it might not make the most sense for my firm. On the cyclicality side, I think that in a bull market or in a healthier market, I think it's kind of easier to get people to look at the sectors. But I think when things are challenging or emerging from a challenging time, that's when it's most complicated.
Joachim?
I think it's different reasons between the different segments at the moment. For instance, in Drive, it's I think an expectation priced into the current pricing of the shares of potentially a further downside to the asset prices and also deteriorating vessel economics. So I think that explains a lot. That said, I think some of the shares like Genco trading implicitly 15% below all-time lows on the vessel value is too much. That's why I have a buy recommendation. I think Golden Ocean, which is trading at a 30% discount to its NAV versus a premium historically, it's too low. So that's why we consistently have buy ratings, because the market has sold off too much. When it comes to oil tankers, I think it's a different story. You have rising asset prices and the sentiment has shifted. Still we see shares trading below NAV. And I think one of the reasons is the ghost of trade war. Although oil tankers is not the segment that's going to be hardest hit by the oil war or trade war, not at all, but it is still hanging over the whole shipping segment. So I think if you get a situation where that trade war goes away, I think it's going to help the whole NAV pricing in every segment.
Foti, do you agree with that? I mean, for me, as a ship owner, I see that the people that really know the business, do the business, they buy and sell ships at NAV, but in the stock markets, we do it at 50% of NAV today, roughly. Is that the reason, the trade wars? What's the reason? The size?
I think market is not that naive as a lot of the ship owners think. And market usually tries to see forward, tries to see what's going to happen the next 6 months, the next 12 months. Obviously, the market, especially for dry bulk, tells us right now that NAVs are not real. And I think that a lot of ship owners also agree. That's why we do not have transactions right now. We see NAVs from Clarksons, from vessel values, but we do not see ship owners act on these prices. So perhaps something is wrong with these prices. They are backward looking and the shareholders are trying to see forward. But there is an additional reason. The problem is that right now, the industry does not have an audience. And the audience of this industry used to be hedge funds, that they were focused primarily on energy. The energy market does not have specialized investors. And of course, the big companies in the energy market, they still have a following, but not from specialized energy hedge funds as they used to be 4 or 5 years ago, before 2015 actually, when when oil collapsed. Right now, you have a lot of generalists. So the investors that they look at energy, they also look at technology, they look at healthcare. It's a much harder sell to try to convince a generalist investor to buy a dry bulk shipping company with no earnings, or a tanker company that has been comparatively much better, when you have a volatility of charter rates of 120%, annualized volatility in the charter rate, and annualized asset value volatility of 35%. This is an extremely volatile business, and for us trying to claim that we can predict the future, I think we should be a little bit more cautious on promises that we make.
I think another challenge is that, again, for many broader investors, or maybe they're even to some extent specialists, they have been hearing from guys like us or from the management teams for years espousing how great the opportunity has been. And NAV, whether or not you're trading at a premium to NAVs, the shares have not performed well. And in this great, bull market has not delivered. And I certainly think there is investor fatigue. And furthermore, I think that the industry as a whole, for governance reasons or otherwise, has something of a bad reputation for not being capital disciplined. And there is a fear, I know, because I hear it from investors all the time. There's a fear that, when the market starts to get very good or stocks start to trade close to NAV, ship owners are going to lose all capital discipline. They're going to go out and order ships, and before you even really get a chance to participate in a legitimate bull market, the whole thing's going to roll over. So what's your real upside? You're in a bad market now, and if your best case scenario is just sort of ho-hum, well, they can do ho-hum anywhere, right? They don't need to be in shipping.
Joachim, you wanted to add something?
Yeah, I think Ben is really onto the issue here, because last dry bulk cycle, at least in 2013-14, you had a lot of generalist money coming in, and they ordered a lot of new buildings, and that basically cut the cycle short. So now trying to raise kind of capital and getting investors excited about dry bulk was hard last year. This year, after the fourth quarter disappointed against all predictions, after the Vale incident happened, so the risk premium investors now are tying to this segment is so much higher than it was just 1 year ago, or maybe 7 years ago. So to get that capital and to get investors to invest in so illiquid shares with low free float and so on, I think it's become a much grander challenge than it has been in many years.
Sure. And then to add to that, you tell the story of these attractive outlooks for certain stocks. The investors all about it. Then they pull up the chart on Bloomberg or FactSet or whatever, and they say, oh, I can't show this to my PM when the chart's down and to the right? So they just, hey, we'll miss the first 15, 20% upside, and then we'll get in, kind of. So there's a lot of interest, maybe on the sidelines, in that I'm not going to jump into this falling knife. Let's see it start to rebound a few quarters in a row, and then we'll get in.
Just to add, though, that if the market does not come back soon, in a year or whatever it is, this NAV is being eaten by the negative earnings.
Oh, of course, but
The market puts a NAV discount both because asset price might drop, but also because of the negative earnings that they are eating the cash position.
Believe me, the ship owner also calculates that he will lose money for a year, but still he thinks the NAV is higher.
Topic, oil tankers.
Oil tankers.
Yeah, we have a massive 145% upside.
Did you listen to that, audience? 145% upside in a year.
It's what we have, and I
Buy.
can, if anyone needs to see the calculations, please reach out. I'll go through it with you. So the reason is very low supply growth. We have extremely good demand growth, even with the OPEC plus quotas in place. We have the IMO 22 kicker coming in with a vengeance from 2020. I think we will see oil product tankers really performing well next year. So we are very optimistic towards oil tankers for the
Eddie, can you
next year.
listen?
So with a Sharp ratio of almost 4 on the oil tankers, that's it's been a long time since I've seen those kind of numbers.
Thank you. Randy, do you share that optimism that both these guys said that the markets will be better at the end of the year than what they are? And
It's hard not to, being at the dearth levels we are now, and my blood type is B positive, so might as well be a little optimistic. Yeah, I kind of share their sentiments. First would probably be wet tankers, both crude and refined products. I think everybody wins there with IMO 2020. You're already seeing kind of a further dislocation of an already diverse crude and product trade, new routes developing pretty much weekly that we haven't seen in a decade plus. The certainty of demand on tankers is very high, the conviction there and the timing of the improvement. I think after you get through refinery maintenance season, maybe that starts kicking up in May, May, June, maybe July.
The second sector, along the same lines, is the oil tankers, both crude and products, because U.S. is producing more crude. It has cheap resources, and because of the IMO 2020, will create the incremental demand from the 1.3, 1.4 baseline demand to produce more distillates, so the refineries will have to run faster. I'm a little bit confused if I should rank on the third place container ships or a little bit uncertain container ships or LNG carriers. I think that LNG carriers, first of all, right now prices are for LNG are a complete disaster, and if you have low commodity prices, it's hard for the shipping business to make a lot of money. Shipping business is whatever is left between the price of the producer and the price of the consumer in the other part of the world, and this gap is very, very narrow. The other problem for LNG shipping that I'm not extremely excited is, first of all, except of the new orders that they were placed the last 12 months, 66 LNG carriers in 2018, record year of orders that they will hit the market for sure, is the fact that this market is not liquid and is controlled by the producers and the major players. And if you go to the Cheniers of the world, that they will need a lot of ships, to the Qataris, they will tell you, we are not going to charter existing vessels. We are going to give a 5-year charter to build more ships. So the order book is going to increase even further. So that makes it a little bit hard for the market, for the LNG shipping market to make great returns. I think that the container ship market next year has a good chance to be a good performer because the order book is very low. Next year, based on our estimates, based on Alpha Liner estimates, the supply growth will drop below 3%. Why the 3% is that important? Because usually this market grows alongside with global GDP. So if global GDP is more than 3%, and most of the analyst estimates is around 3.5%, we think that we're going to have an improvement. And also, this is a market that is controlled by a few liner operators. And these liner operators are not putting a lot of scrubbers. They will slow steam. So for 1 year or two, I think we're going to have an okay market.
And you didn't say something about the dry bulk. I presume the previous 3 companies, 3 sectors that you mentioned, you see share prices increasing. You see an improvement in values from where we are today, right?
I think that the liquidity discount for the liquid stocks will remain high. But I would expect, yes, they would increase. The larger companies, the more liquid companies, they will trade better. The smaller, more illiquid companies, they will maintain a liquidity discount. For dry bulk, I would expect, before I touch this market, a major event, a Hanjin event type of event, some big bankruptcy where prices will reset at more normalized levels to reflect the supply-demand outlook. I don't think that asset prices reflect that. When this big bankruptcy happens, obviously a lot of people will panic. Let's not forget that the balance sheets for most of the dry bulk companies right now, despite the terrible market, are still very strong. Last year it was a good year. 2 years ago, everybody restructured their balances. They recapitalized the companies, the ones that they didn't go bankrupt. I think that we need another reset before we touch dry bulk.
The Vale incident was a reset, I think, but you expect an incident?
I mean, from the ship owners' side. Some, I don't know, people are talking about companies with VLOCs that they have financial difficulties, but there are going to be a lot of companies.
For offshore, I presume, because I see we're short on time, for offshore, I presume you're not very positive, or what's the...
I do not spend a lot of time on
You don't
offshore,
spend
so
time on it, okay. Ben, you are the last one.
I'll be quick. Yeah.
Good.
So I think honestly, what I've learned over the years is sometimes psychology is more important than fundamentals, and I think that if I had to pick one sector and I had to put money on this is probably going to be higher a year from now than it is right now, it probably is dry bulk. I can't tell you that I love dry bulk, and I can't even tell you why dry bulk will probably be higher next year, other than it is just so awful that at some point, things that are awful don't stay that way. You know, and I agree with some of the things about, you know, U.S. exports and all that kind of thing, but I think there is outside of maybe IMO 2020, there's a lack of real authentic belief in money behind it. And so I think I'm not as excited about the crude tanker market. I think it could be up, but I don't think that we close the NAV gap this year or next. I agree with Fotis about LNG. I think it's okay, but that's probably the last area I'd put money in right now, frankly. I do like the LPG though. I think that's a little bit different. And offshore, I think offshore kind of does nothing. I think it just kind of hangs out because people don't have any conviction there, and they don't have any reason to have any conviction. And so that's the real thing, is people need to have a reason to buy some of these things. I think you could have reason to buy the dry bulk because it's awful. You could have reason to buy tankers because of IMO, but if that ends up, you know, not being a big deal, then
And containers?
Containers, people don't care about containers, I'll be really honest.
That's what I realize, yes. We are a container company, one of our companies.
No offense, but
No problem.
I get one container call for every 100 other calls. So.
Right.
I don't know about going private again, but there's definitely been a disconnect between earnings and equities, and we've seen that. So we cover 28 shipping equities at Jefferies. 21 of them have either repurchased shares or authorized a share repurchase program in the last 5 or 6 months. So just today, I think DHT announced some more share repurchases. So that's going to be a common theme, especially with free cash flow and equities trading so poorly. In terms of taking it all the way private, you'd have to have a third party coming in and kind of forcing that issue. I don't think any public CEO is going to say, hey, let's just take this private. Let's stop the equity markets. We don't want that public access to public capital. That's going to be difficult.